mentioned onto earnings interactions, then LIC Housing, after their fourth quarter results, asset quality saw an improvement. The disbursals were up 24% sequentially. AUMs also grew 3% during the same period. We are now being joined by Tribhuwan Adhikari, who is the MD and CEO of LIC Housing Finance, to discuss the road ahead for the company. Mr. Adhikari, good morning. Thank you for joining in. And I'd like to first start off with your loan growth bit, right? A single quarter or a couple of quarters of single digit growth, you would say, okay, it's a one-off, but it's been 9 quarters now that your loan growth has been in single digits. What would you attribute that to? One, and two, in FY26, are you aiming for a double-digit loan growth as well?
Well, yes, honestly speaking, 9 quarters in a row, single-digit loan growth has been disappointing. Yes, it has been disappointing. Last 2 years, there were some issues within the company, change of the loan management software and all that. But I think that is all behind us. The last quarter, the growth has been good, 24% overall. Some segments showing as high as 45% growth in the project loan book, etc. So I think that is all behind us. And this year should definitely we should be aiming for a more than double-digit growth, both in the loan book as well as the disbursement book.
Low double-digit, high double-digit?
10 to 12% is the guidance right now.
Okay. Could you can you break that up in terms of home loans and the developer loan book? Because I believe in the prior quarter, your developer loan book declined by 13%. First, what's the reason for that, the developer loan book? And then break up your guidance of next year of 10 to 12% in these two segments.
Yeah, the developer loan book did decrease, as you said, and it was partly because of big I would say, the rate of interest at which we were willing to underwrite the big loans. Many of the loans which had been granted 2 years, 3 years earlier at higher rates of interest, they were demanding rates of interest which we felt were not tenable for us. And so we had to take the painful decision of letting them go. But as far as the disbursement book is concerned, in the last fiscal, the project loan book has grown by almost 47%. So we are looking to grow this book. Last year, we had done 4,200 crores of disbursement through the project loan book. This year, we're aiming for 10,000 crores of disbursement through this book. Again, at the same time, we are cautious in growing this book. Our past legacy, our history has not been very good as far as this book is concerned. 50% NPAs at one point of time. Right now, we're down to 21. So it's going to be a cautious approach, but we feel there is definitely a market for this, and there are good quality builders with pedigree who can be taken up and who can be pursued for growing this book.
Mr. Adhikari, I was just checking your disbursements were up almost 24% on a sequential basis, but that has not translated into very meaningful AUM growth. It's just only 3% on a sequential basis when you compare that to the December quarter. What has led to that, and do you see that improving as we go into the new financial year?
Yes, definitely. I do see improvement going into the new financial year. In the last quarter, the book transfers have been slightly high. So retention was a cause of concern in quarter 4 for us. But then this year we would be setting up a separate retention team to look into how we can hold on to these existing loans and at the same time grow the new loan book. So definitely this year I'm optimistic that there will be a good book growth as well as disbursement growth for the company. 12%. Yeah.
Got that. What about net interest margins? Considering that we are currently in a declining interest rate environment, what is the NIM range that you're targeting, or the outlook on net interest margins? And even the asset quality has been improving for you. Your credit costs have been fairly benign. What is the outlook for FY26, or the first half of the year where you have visibility?
Well, as far as the NIMs are concerned, we ended the year at 2.72, and that was the guidance we had given between 2.7 to 2.9. Yes, the margins are the net interest margins are going to be volatile. RBI has already done a 50 basis point rate cut. I'm expecting another in the June MPC. Going forward, I believe the trend would be towards lowering of the repo rate. So on one hand is the repo rate. As far as my borrowings book is concerned, 55% is fixed cost borrowing, where I do not see any, there is no scope for any improvement in the borrowing cost. 45% is linked to the repo rate. So there we will be seeing a downward impact on our borrowing cost. So I think with this year we need to balance between we have to be very cautious about the borrowings we do and ensure that we are very aggressive or we pursue lenders to give us excellent rates. Very recently, a new channel has opened up, RDBMS, company set up by NHB. PTCs, the first PTC deal was done and listed on the exchange very recently. We'll be looking at that also. So borrowing costs would be important. And as far as the repo rate cuts are there, they would be there. The cost of lending would have to come down. We are operating in a competitive scenario. My loan book is comprised of 85% of individual home loans, a very competitive segment in which all the banks are present and where the margins are really very small for the companies. But at the same time, since 85% of my book is there, I cannot afford to price them higher than my competition because then in that case, I would lose business. So it's going to be a very tightrope walk for maintaining margins. But I believe we should be able to maintain the margin between 2.6 and 2.8 this year.
Okay, but there will be a downward bias from where you ended, considering that 55% of your borrowing cost is still fixed. And when it comes to loans, given the competition, you will have to price it down as and when the interest rates come through. So, bias could be
Yeah, of course. The trends point to a downward bias.
But 2.6 is the base.
Yeah, but we need to diversify. We need to diversify our business without losing sight of our individual home loan book, which is our mainstay. We need to diversify into other margin accretive segments like project and the LRD and the lab space.
Mr. Adhikari, what are you expecting in terms of your asset quality, sir? Your gross NPAs and your net NPAs, what are you expecting them to be? Have you set any targets for the year?
Well, right now, my gross NPA is at 2.46. We are targeting 2.2 in the current financial year. The asset quality has been improving every quarter, and we expect that trend to continue. So my target for the year is about a GNPA ratio of 2.2 down from 2.46 as of now.
All right, Mr. Adhikari, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well as the management of LIC Housing Finance. Expecting the NIMs to remain volatile in FY26, but is hopeful that the asset quality will continue to improve in this financial year as well. The stock had nearly moved into the green, but has recovered significantly from the lows of the day after the management commentary. So LIC Housing Finance still 0.5% lower at 621. By the way, some other negative